wanna say it loud, 'cause someone out there listening. If you're gonna think it, think out loud, 'cause they don't know what you're missing till you let them all in. Oh, oh, oh. Tell them what it's all about. Oh, oh, oh.
You're listening to the Divorce Registry podcast, talking about real people, real issues, and real solutions.
I'm Jonathan Fogel, a family law attorney.
And I'm Amanda Johnson, a family law paralegal. This is the Divorce Registry podcast, where we provide informative, entertaining, and invaluable insights into all aspects of family law. You can reach us at thedivorceregistry@gmail.com, and be sure to follow us on Facebook.
Amanda and I are partners at work and in life. We are both divorced, and we have 5 kids between the two of us. Some call it chaos. We just call it family.
We call it chaos too.
Yeah, you're right.
The signs say you'll be coming up roses soon. It all comes back to you. It all comes back to you.
Welcome to the Divorce Registry podcast, episode 2.
Episode 2.
I know. It's so exciting. I'm really excited for this episode as well. When people go through divorce, one of the biggest assets that a lot of people have is their house.
Yes.
Right? Sometimes it can be the biggest asset. It also can be the biggest liability.
Yes, which
sometimes.
was true years ago.
Yes.
Seemed to be.
And maybe now as well, although it seems like the market has turned around a little bit and homes are increasing in value. But a lot of times people come in and they have a house and they either want to keep it, they want to figure out if they can afford it, they may have to refinance, or someone has to go and buy a new house, and are they going to be able to qualify to buy that house? And then they got to figure out what are they going to do with the mortgage that they owe on the house maybe that they don't keep, or the people that keep it, how are they going to afford it, and can they refinance to take the other person's name off the mortgage, right? I mean,
Right.
a lot of issues dealing with house.
This is why I rent. I'm just kidding. No, it's not. It's not. But my divorce I went through. We ended up basically losing our home. It was just something that had to happen in order for us to both move on. And I rent to this day, but we have clients who need to know, who are keeping their home and need to know how to move on and purchase their next home and keep the other home for the other spouse. And so there's a lot of things going on there.
Yeah, absolutely. And so that's what we're going to talk about today is issues related to the home and refinancing. We have our expert here today, Mitch Irwin, who's a loan officer and a home mortgage specialist. Or is
Love
that right?
that title.
Divorce mortgage specialist. Thank you. Divorce mortgage specialist. Mitch, welcome to the program.
Thank you for having me.
Yeah, thanks a lot for being here.
Yeah, it's fun.
So far?
Yeah,
It's
So
fun.
far.
It
Great 20 seconds.
hasn't even started, and you're already having a good time. That's good. So one of the things I want to talk about, we hear a lot of people talk about these things, and the terms I want to define so our listeners can understand the difference between if your name is on the mortgage and your name is on the title of a house.
Yeah.
So what's the difference there?
So the technical language, I mean, it's the mortgage industry. It should be called like the loan industry or note industry. The mortgage is actually just a security document that gets recorded at the county.
Okay.
That secures the lien for the bank or the creditor or whoever has that. The title is like your ownership of who owns it, and so you can have people on title and they're not necessarily on that loan
Right.
that gets recorded.
Right. Or vice versa.
Or vice versa.
Right.
I
And
mean,
we see-
I see that actually probably more common when they come out of a divorce. Their name might still be on that loan, but yet they've been removed from title through the divorce decree.
Got it. Right.
Can you still buy a new home if your name is still on the old home?
Yes, if the divorce decree is worded properly.
Okay, key.
Yeah.
Okay.
Yeah, that's the key.
That's
And
the key.
Yeah. And I know this is super sexy stuff. You're talking about, talking about loans and mortgages and refinancing. See, Mitch is like lighting up. This is your wheelhouse.
This is I'm pretty passionate about it. I don't know if too many other people are.
Yeah.
Divorce and mortgages are two things that are that's my world.
If we could only mix taxes in here somehow, we'd really be excited.
We'll probably get to that
Yeah.
at some point. So.
Well, look, the reality is, though, and this is what we talk about all the time in our office, Amanda, and we talk about this with clients, is that this isn't the sexy part, right? This isn't but this is the part that's super important because it can impact not only what's going on in the divorce, but what's going to happen afterward. And your question, Amanda, of, well, what if I'm still on the title of my old house, or what if I still am on the mortgage on the old house, and now I'm divorced, I want to go buy a new house.
Yep.
Is that possible? We get that question all the time.
Yeah, so the first part of that, the title piece of it, is usually addressed through the divorce decree. It'll say the home is awarded to someone, and then they're going to be effectuate the transfer of title through recording the certified copy of the divorce decree, or the summary real estate disposition judgment, or the quitclaim deed.
Correct.
Most commonly, it's good to have all three of those in there in case you get a non-participating person afterwards.
Sure.
So that title piece is kind of taking care of itself. But what I deal with a lot, and the heart of the question is, can I go buy another home if my name is still on that old loan because my ex doesn't qualify to refi and get my name off?
Right.
Just doesn't qualify or doesn't want to, maybe because they got 3.5% 2 years ago or something, and wants to preserve kind of the terms on that loan.
Right, and people have to understand is that a divorce decree, right, can order someone to do something, but only if they're a party to the divorce. In other words, the judge can order mom or dad or husband and wife to do something, but they can't order the bank.
Yeah, the bank didn't grant that permission just to some
Right.
Hennepin County judge to,
Right.
to do that. So,
Right, and so so the bank isn't bound by the fact that someone has to refinance. And so that goes back to, when should people come to you to start talking to you about, can I
Right.
refinance?
So I want to give that full answer just a second.
Yeah.
That like the answer is yes, you can go buy a home, and we can exclude that payment as long as that divorce decree has been entered. So that's, in order to exclude it, it's got to be a fully entered divorce decree.
Okay, so it has to be pursuant to a court order, a final divorce decree.
Right. Now, we should mention this is, we're recording here in Minnesota, but this is a national thing, right? Or
Right.
potentially,
Yep.
there's other states.
Well, we're hoping people will listen.
Yeah, but
that's the goal.
I was chatting with somebody in Washington the other day, and they're like, they don't enter their decrees for like 6 months after
Right.
they've entered the filing or something.
Sure.
So
I think California might be like that.
yeah,
too.
so there's other states. So Minnesota, basically, you file your divorce decree, and
Yeah.
anywhere from
There's no waiting period.
correct, yeah, or 1 week later you're divorced or whatever it is, or depending on the county. So the answer is yes, you can exclude that payment for the purposes of going to qualify for another home loan. It'll still show up on your credit report.
Sure.
But internally, we check a little box that says exclude, and then we don't count that in your debt ratios, and everything's based on everything else: your credit score, your down payment, your debt ratios of all the debts that are yours
Yep.
after that divorce decree. So you can exclude auto loans, you can exclude credit cards.
There's a magic box.
There is a magic
That's
box.
what he's
That's
saying.
what I'm hearing.
I've got it. So anyway, yes, you can exclude it. You can
Okay.
but no, what that doesn't do, it doesn't take it off the credit.
Right.
Right.
So if someone if X misses a payment,
Yeah.
that is going to affect my credit,
Absolutely.
even though I'm not on that. Even though the decree requires that person to do it, it's going to affect my credit, which could affect my ability to get a house then.
Absolutely. Particularly, like, let's say you get divorced and you want to be approved and you exclude it, but you haven't found that right house yet. So you go 6 months or a year without finding the right house you want to buy, or you rent short term for some reason in a lease, and your ex missed a couple payments.
Sure.
Well, now your credit score is going to go down. You've got mortgage late. Then you're done. Or you're not going to
So
get
it seems to me, best case scenario, right? Best case scenario is you're getting divorced. That's not the part of the best case scenario.
I
The
was
best
gonna
case,
say.
no. But the best case scenario in a divorce proceeding, when there is a house, is that if one person keeps it, that they remove the other person's name from the mortgage.
I highly recommend it. I mean, there's certain instances when it all depends on the scenario, but if you really trust it, if your ex really preserves their credit score and really values that, and and they've got the means to pay it,
Right.
yeah, then you're probably less risk than someone who, like, man, I don't know how they're going to keep it, but she wants to,
Right.
and I'm going to let her because I don't want to stir the pot. Well, if the numbers don't lie, there's a good potential she'll miss a payment.
Right.
That's scary,
Right.
and then you should either look at other plans, either selling it, refinancing, forcing those items, selling, refinancing, or some lenders allow an assumption.
Yeah, what's the difference between that? I hear this a lot, right? We hear, you can go refinance, which is different than an assumption of a
Yep.
mortgage. So tell us what the difference there is.
So an assumption is you're going to contact your existing servicer, whoever you make your check to, and call them up and say, hey, I'm getting divorced. Can I remove my ex's name? A lot of times they won't approve that or even have that full
Because
conversation.
they got both of you on the hook,
Yeah,
right?
right.
Why would they let one person off?
Yeah, it's only a method to kind of preserve that borrower, the loan, and say, yeah, we still want to keep this loan on our books. So they'll do that, but you do have to qualify. Like you've got to, they're going to pull, you contact them, they're going to send you a bunch of forms, kind of like refinancing, and they're going to pull your credit and they're going to look at your debt ratios, kind of the same criteria. And some lenders will, and some, or a lot, frankly, won't. And they'll just say, no, it's you sign something saying it's non-assumable. You have to refinance if you want to take a name off. But there's some lenders out there that do.
And I take it there's different costs, right? I mean, to assume there might be a little less cost than there is a refi.
Correct. So, I think the fees range probably from $500 to about $1,500 is the max I've seen. And that's because they got to process it and
On the assumption.
Yeah. Sure. They got to pay people to look at all these things and stuff.
Because with the refinance, you're getting a whole new interest rate, and they have to rewrite a whole new loan.
Right. And I would tell you, because 2/3 of my business is divorce. I deal with that every day. And I'd say out of those scenarios, if I had 100 phone calls, there's probably 20% of those where they just want to keep the current loan intact and that payment because they can make it, and they've got other assets maybe to buy out the equity in the home.
Sure.
So they've got something to trade that equity portion with.
Careful with the microphone.
Yep, and they move. But I would tell you, a lot of people end up, they're like, man, I got to come up with $100,000 to buy out my ex. I don't have that liquid, and they don't want it in retirement, and they're not willing to take it that way because they'd be taxed on it.
Sure.
So they may have to do a refi. Or they've got other debt that they should be consolidating. Or maybe on two incomes, they were on a 15-year loan, and everything was just peachy, and then now can't swing that type of payment on their own and has to go back to a 30-year. So you do end up refinancing to change the term, pay off the debt, pay off the spouse, those types of things. Just to make it a better loan overall, regardless if you're giving up that interest rate.
Well, and when people are calling their lender to ask about either a refinance or possible refinance or assumption, will the lender start and they'll say it's pursuant to a divorce, we're going to be going through it. Do they start asking about, well, are you going to be getting maintenance, or if it's the
I don't think they'll even talk to you really.
They won't do that.
They won't process it until you have a divorce decree because they're not going to let someone. Yeah, okay, you're getting divorced. We'll just let you off the hook, and then I could go on a list of reasons why they wouldn't do that.
But it's a good idea.
But they want to make sure you're not obligated to pay a whole bunch of support.
Right.
They're going to make sure you qualify.
Yes,
is the crux of it.
Got it.
And I mean, it seems to me, Mitch, when it is a good idea, though, for people to start coming to you maybe before the divorce decree is finalized.
Absolutely.
To come up with some scenarios, right? And I know you do that quite a bit. You kind of help people figure out, okay, if you're going to get this or if you're going to pay that, and if this happens and this happens, we can kind of get an idea of, I don't know if the pre-qualification or something like that. Is that the right term?
I think it's critical because it avoids the client spending money to keep a house that they can't afford, or that they won't qualify to refinance it, or the timing would be all off. And I usually don't charge for that analysis. So I think it's the best value in family law, just because you get really good info to know what is the key language that's got to be in the divorce decree.
Right.
Or just sometimes it's an eye-opening moment to say, yeah, you can qualify, but this payment is going to be X, and are you comfortable with that? And they're like, whew.
Well, and I know when I've used your services before that, I can tell the clients that, and I can sit down and explain to them and like, look, are you sure you want to keep the house? Because the mortgage payments may be this, but then you got the utilities, then you have the upkeep, you have, when something breaks and you got to fix it, and you have all these other things. Is this really the house that you want to keep? Or maybe it's better sell this house, downsize, move into something a little smaller, so you're not just all your money's going to that, and then a year from now you have to file bankruptcy because you overextended yourself.
It's such an emotional attachment, though.
It's hard, though.
I
went through the same thing in my divorce, right? Is that I so badly was like, I want to keep my kids in the same house. I want to make sure that they're okay because that's going to be the emotional anchor for them, and sometimes it's not, and that's a hard thing to realize, but sitting down with you can really help them understand that.
It's hard to take the emotion out of financial decisions, It's something you live in, the kids live, and so I see that a lot, but that's one of the reasons I started focusing in this area about 14 years ago, was because I was seeing a lot of people post-decree with lots of credit card debt. What happens is people keep it and they make the mortgage payment because they've got to make that.
Yeah.
But gas and
then they run
groceries
up.
and everything else goes on credit cards. So from my opinion, just being an uber conservative on financial stuff is, you increase you accrue debt. Sorry.
Yeah.
You accrue debt, but you also prohibit or you can't save for retirement
Right.
and 401k contributions and just for rainy day funds. And, so then you end up borrowing money to replace a $1,000 water heater.
Right.
So-
And what if your kids want to be in an activity?
Yeah.
Right? And you're like, oh, well, sorry, guys, I'm making the mortgage payment. And I know those are tough decisions, right? I mean, we all make decisions, right? There's needs and there's wants. My kids, I always tell them, look, you may want to get the new PS4 game, but you don't need the new PS4 game, right? You need food, you need a place to live, you need clothes, you need to go to school. But do you want to be in a situation where everything has to be no because all of your money is getting sucked into a mortgage payment that's probably way too high
Right.
for your income range?
And if you've got a lower payment or something that fits your budget better, you can take them to Chuck E. Cheese or buy the Nintendo game or whatever that is once
They
in a
still
while.
have Chuck E. Cheese's? I used to go there all the time.
It's an old example. I've been
I
doing
say
this for a
Dave and
while.
Buster's now. That's kind of like the
that's the
adult
newer one.
version, right?
Yeah.
That's more fun for
Yeah,
dads.
maybe they'll sponsor our show
There's still
now.
Chuck E. Cheese.
Maybe we get Dave Buster's
free
sponsor.
free plugs. There.
Nice.
Well, let me ask you this. You were talking about this because there's never enough time to talk about these things.
Yep.
So I want to get to a few of these points. But what you mentioned this earlier about the income to determine whether you can qualify for a mortgage. So when can child support and alimony, we call it spousal maintenance here in Minnesota, some states call it alimony, but when can that be taken into consideration for the person that's receiving it in order to qualify for a mortgage, right? Because if they're only making 25 grand a year or whatever it is, maybe that income itself doesn't qualify, but they're receiving spousal support and they're also receiving child support. How can that be taken into consideration?
Yeah, so that's the first thing we do is we determine do they need it to qualify because, we had the great meltdown of all the real estate stuff about 10 years ago. Lending rules really tightened, and then they've kind of slowly eased up. And I kind of hope they're about as loose as they should be, to be honest, right now. So sometimes I'll do loans where you don't need the child support, and it's really tight on paper with a high debt-to-income ratio is what we look at. But in real life they're going to be fine because they've got that income coming in. They just don't want to wait that 6 months or 3 months, depending on the type of loan. So you first determine if they need it to qualify or not from a timing perspective. And then the two is how much are those things going to be? If it's child support, we're going to look at the ages of the kids. If it's alimony or support, spousal maintenance, we're going to look at how long is that duration going to be
Sure.
and some things like that. But if you take all the loans in the country, the majority of them are going to fall. I think the percentage is around 70% probably is conventional loans, which are Fannie Mae and Freddie Mac. That's your typical 30-year fixed, 15-year fixed type of product. You got to receive that income for 6 months.
The income for spousal maintenance or child support, you have to be receiving that for 6 months in order for it to be used
Qualifying income.
as income.
Yep.
Okay.
Yep. In order to use that income to qualify, you got to receive it for 6 months because, frankly, just because it's ordered doesn't mean people pay it.
Right. And that's the other thing you just said, it has to be ordered, right? It can't just be a voluntary payment of 6 months. It needs to be pursuant to that divorce decree.
Correct. In the sense of in order to use that chunk. Now, you can get a temporary order early, and I do recommend it if you got an official judge's order, but otherwise you can use it on a lot of loans if you've got a kind of an agreement between all the parties and the attorneys, and then the most important thing is having the paper trail.
Right.
And it's got to be a check or a transfer from one person to the other. You can't just say they made it.
Right.
And it can't be paying the bills of the mortgage and the auto
Right.
loan.
So I see that a lot, right, is that someone comes in and says, well, I want to use my spousal support as qualifying income. And I say, oh, is there an order? And it's, well, no, they were paying the mortgage on my behalf instead of giving me the money. And that's not the same thing.
It's no different as a happily married couple. I mean, so it's not truly giving someone support. So
Okay.
by coming in early, because the theme of this is get in early, and we can suggest, cutting that check, let's say from husband to wife pays the mortgage. Same thing, mortgage still gets paid. It's just now you've got that clock ticking for the 6 months.
And how long does the person have to be receiving the spousal maintenance in order to be qualifying income?
That's 6 months.
No, how long in the future
Oh,
do
in the
they
future,
have to
yep.
be receiving it?
So there's receipt and continuation. Continuation is how long is it's going to, because if it's a year, 2 or 3, it's a 0.
So if someone's getting 1 year of spousal maintenance, no matter how much it is,
$20,000 a month, still a 0 on
because
our
it's
loan
not long
application.
enough.
Correct. We look at things. The rule is it's got to continue from 3 years from the date of closing.
Closing
So-
on the house.
Yeah, on the loan.
Okay.
So whenever if you receive it for 6 months, then you just got to have 3 years yet remaining. I wouldn't do 3.5 years. I would do 4.
Okay.
And what that does is, you got 6, and then you got the next 36. That gives you from a 6-month window there, essentially from 7 to 12, to find a home, to refinance it, those sort of things, to get it done. So 4 is kind of the minimum duration I would look at or recommend, if possible.
And what if it's $3,000 a month for the first 3 years, but then drops to $500 a month?
Oh yeah. So step downs are.
Oh yeah.
Oh yeah, step downs as we call it,
Step-downs,
which
what
we
we
see
call-
quite a bit. I mean,
You do, a lot
and there's
of time-
nothing wrong with step downs from a settlement purpose or a
practical
purpose, because
budgeting.
the whole idea of step downs is the idea that maybe the person that's receiving the maintenance, whether it's the husband or the wife, it gives them kind of a launching pad to get out there and get a job, but it doesn't have a direct cutoff. Like, okay, it's 4 years and then it's nothing. It might be 3 years and then step down a little bit, and then another year step down a little bit, because it gives them kind of a way to bridge to the working.
Yeah, sometimes they're going back to college and they're like, hey, we got 2 years to get the degree, and then I guess she'll presumably going to get a better job, and so then the income would be higher. It wouldn't need.
Right. But how does that
as much.
affect mortgages?
It's not good.
That's what I was waiting for. And there it is.
It's not good. That's the answer. We're done.
We're
It's just
we're
not
going
good.
to use essentially what's going to be, from the date of that closing, what's it going to be 3 years from now? And if it's stepped down once or twice, whatever that number is, at that point, it's what we're going to use on the qualifying. So, yeah, if you go from the classic example I had a couple of years ago, because I was working with both parties, was they did $3,000 a month for 2 years and then $2,000 a month for 2 years. So it's a total of 4 years. And if my math is right, I think that's a total of $120,000. But it was kind of a double negative because she was paying the maintenance, and as the payor, we had to count the $3,000 against her because that's what's going to be happening.
Okay, so that's out of her income for
Yeah,
purposes
so
of
that's
qualifying.
a debt for her on that, the higher numbers of debt, and then he could only use the lower number because that's what was going to receive after that step down.
So you'd have to use the 2,000.
Correct. So
As
if they
qualifying
had done
income.
$2,500, it's a month. It's over the 4 years, still $120,000, same total dollars. It just would have helped or made their loans easier.
Sure.
And
Sure. So
benefited
you
them
can.
both.
So there's some of that. You work with the clients or work with people going through divorce to kind of help them understand that, as well as even reviewing language and decrees before they're entered to say, hey, this is going to cause a problem, or identify maybe areas of concern.
Yep, I closed a loan this spring. It was like must have been March, April, somewhere right around there, because last fall they had thankfully they ran it by me. I do a lot of previewing divorce decrees to make sure the language fits the mortgage world, but they did 3 years. Whatever dollar amount it was, I can't use that because after 6 months, there's only 2.5 years remaining. It just doesn't fit. Fannie Mae, Freddie Mac, FHA, VA, they all have that. And to back up a little bit, FHA and VA do only require 3 months, not 6.
Okay.
But those are a smaller number of, there's not as many
In the
veterans
scheme of
available.
things, they do
Yeah.
less loans.
Yeah, there's not as many veterans out there, and FHA loans have a little higher mortgage insurance and stuff. So not as many people want to take that. They'll just wait the extra 90 days, or
Sure.
should wait the extra 90 days and use it that way.
And I do think we have a lot of clients who are so anxious to get through the process and to get the judgment and decree done and entered, and to just take a moment and to have somebody review it outside of your attorney who's drafting it, because we don't know all. I mean, we do learn all this from our experts, but we need their help to make sure you're covered.
Absolutely. Absolutely. And I think it's really an important thing for the clients to understand that there is a lot of moving parts, and that these are things that will affect their ability to get that house later. And they're like, no, I want to refinance. I want to get the other person off. But it still has to be done properly in order to give them the best opportunity. And I know can't guarantee that, if you do this, you will be able to refi, because there's still qualifications they have to go through. but that's certainly a better way to approach it.
Yeah, if we stick with the theme of getting involved early, we see what their credit is. You identify accounts or balances that might be a surprise. I have that come up, and once or twice a year where, like, hey, what are we going to do with this $30,000 of credit card debt? And they're like, what are you talking about?
Yeah.
And like, it's just floors them. And
Yeah.
that's a tough conversation. So it sends them back to you to address some stuff that they didn't know about. I think this previewing the decree, and I have to state that's not legal advice. It's just mortgage advice.
Right.
But what I also, as we segue into other parts of what we want to talk about is how you craft the buyout to your ex-spouse is really key.
Yeah, great. I'm glad you brought that up because I had this written down. Is that this idea of should it be a buyout or a marital lien? How do you, as far as the money that's coming from the property division? Because what we do is, essentially we create these balance sheets. It says, okay, husband's getting these assets, wife's getting these assets, and there's some property equalizer. Maybe the person that has a little bit more assets on their side of the scale has to pay some money to the other person. And if that money is going to come from the equity in the house, you're saying there's a better way to maybe word that to make it easier to refinance.
Correct. Essentially, if you treat it, as a marital lien on the home, so the home at XYZ legal description is awarded to wife subject to a lien in favor of husband for $50,000. That's treated as a buyout of a co-owner from a lending perspective, and it's less risky than wife's going to take $50,000 out.
Okay.
And, cash out. And then so basically a lot of times you'll see a cash equalizer is a term we see a lot towards the back of the decree. And that's for the value of, the boat that he's keeping, and then her car's worth more, and all this checking accounts and things. So there's kind of an all-encompassing thing. And if you word it that way, then it gets coined as a cash-out refinance. And not only does that limit you, in most cases, to 80% of the value of the home, so it's a little more restrictive on what you can actually do, it's also at a higher interest rate. And the automated underwriting engines, they're a little tighter on those.
Okay.
I mean,
You can't grease those little and
well,
loosen them up.
it's less, it's riskier.
Yeah.
So they're not going to approve that 641 credit score like they would probably on a rate and term refinance that is on a marital lien.
So the industry simply looks at that and says, well, if you're doing a cash buyout, that term in itself is riskier than, if you're just buying out a marital lien, which is simply buying out a co-owner's interest, you're going to get a better chance of refinancing and potentially a better interest rate.
Yep. You can go all the way up to like 95% of the home's value. So I don't have time to write out real hand examples, but if you've got kind of limited equity situations, that's key to getting it, number one, the deal done. Number two, a little more detailed example of that is how it gives, there's an opportunity, I would say, to be creative with it in how you address some of these other debts. And the example I would give is someone came in I met 2 weeks ago with, and they said, well, he's gonna refinance. His dad's gonna co-sign. He's gonna pay off the credit cards with the refi, and she wanted to go buy another house. And I kind of like, whoa, there's all kinds of red flags there because she's depending on his refinance to pull out the money for her down payment on a home. Problem is, that would have been a cash-out refinance, and you can't have a non-occupying co-borrower, so you can't have a co-signer, essentially, on a cash-out refi. So that language would have killed kind of that deal.
Sure.
And you can't just roll in those credit cards. Now, what they can do, and this is kind of what her and I talked about, and then she's going to go talk to her ex, is if you make the marital lien to her bigger, you can make it a lot to encompass paying off those.
Oh, sure. So you
credit
just make the
card
marital
debts.
lien better, and then when she takes that out, she just uses that money to pay off
The credit card
credit cards.
Yep, and you would put that she's ordered those debts to pay in the decree,
Yep.
so he gets to exclude them on his end. Back to that excluding thing.
Sure.
That payment is excluded. He does the refi. He can have dad as a co-signer. Big check is cut to her. She pays off the debt. She uses the remainder amount for the down payment on her house. It works better for both of them. In terms of clearing out the debt, getting a better rate, getting dad to be able to co-sign with dad because he was newly self-employed or something. It makes it all possible. And if they had done it the way they're kind of proposing, which is, I think it's the same end result. It's just a different way of getting there.
Sure.
That's more likely to have success.
It's great advice. I mean, really invaluable advice for people that are going through this. Like I said, it's one of the biggest emotional issues that people deal with when they're getting divorced for a lot of reasons. One, they feel like that's kind of the last, especially when there's kids involved. They've been in that house for a while. Their kids love the neighborhood. They love the area. They love the house. It's got they have a lot of attachment to it, and letting that go and trying to figure out how to salvage that is really difficult. And so I appreciate you so much for coming in. We always run out of time when we're talking about. So I felt like it was good stuff.
It was good stuff.
Good information.
Really good information.
Yeah, thank you so much for coming. And be sure to like us on Facebook. Go to our Facebook page. You can learn more about Mitch at our Facebook page. And if you have any topics you want us to discuss, send them to the Divorce Registry at gmail.com.
Yay.
Thanks for listening.
Thanks, Mitch.
The information in this podcast was for general purposes only. The information provided was not legal advice or a legal opinion. You should seek the advice of legal counsel of your own choice before acting upon any information from this podcast. Contacting us by phone or any other means does not establish an attorney-client relationship.